listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. With me again, returning guest for, I think, the third time, he's Vince Lanci. Vince, there's a lot to talk about, so I'll stop with the long intro. I think our listeners know who you are by now. But give me your thoughts on what's been happening. I mean, you noted that oil basically has cracked. Is that what has impacted the gold market in the last couple of weeks, or is it a combination of things? Is it something else? What's your view?
Yeah. Well, what we talked about before, and I'll try and restate that more lucidly, is that since the Fed admitted, we'll put it this way, to answer that first question, oil didn't take gold down. Gold is the collateral damage of them trying to get oil down. And today oil cracked, so you may have another effect of selling in gold and silver especially, and we'll cover that as well. But the goal is to get oil down, and they don't care what they have to take down with it. And you can see that how stocks are acting to get oil down. And that's been my thesis, for lack of a better word, since April. And today, this is why this is a fortuitous call. Today's the day that I think it happened. Now, we had another drawdown in oil before, but I think today's a little different, and we can get into why that's different in a minute. But to answer your broader question, since April, when the Fed basically admitted they were wrong, right, about inflation, they have been on, and this is not me talking. This is that guy Zoltan Pozsar, who he's not a messiah or anything, but he worked at the Fed and he's respected and he has their ear, and he's probably just a little bit too frank about what they're doing because he hasn't written anything recently since his most recent tell-all missive. But anyway, his explanations are really hard to get through the first time you read them. But once you get through them, this is what he said. He said this back in, it might have been, I think he said it in February, and then he restated it in April. And what he said was, the Fed needs to get inflation down. That's their goal, number one. Number two, the Fed is not going to mind if they get stocks, bonds, and commodity. Well, they certainly want commodities lower, right? Stocks and bonds lower to do it. Why does the Fed not mind when in the past they have minded? They don't mind because they're kind of stuck in that situation because a lot of the inflation that we have, and I'm not apologizing for the Fed here, I'm just trying to explain it from their point of view or from everyone's point of view. A lot of the inflation we have is supply side driven. So we've embargoed goods from Russia. We won't take their oil. And so that basically, even gold. And initially what that did was not initially, it's continuing to do it. It split the commodity markets into two. And it split the commodity markets into two along one very distinct line. And that distinct line was stuff that we didn't sanction versus stuff that we did sanction. And that line also happens to bifurcate the world geographically, right? Russia and China, Russia versus the rest of the world. China's, kind of playing both ends, both sides of it. It also, coincidentally or not, and this is what we're getting at in terms of why stocks are down and why other assets are down. It also divides the world into two in terms of if Russia and everything east is where where a lot of spot commodities are, palladium, right? And everything to the west of this imaginary line we're drawing is where financial futures markets flourish. And from the whole Exeter's pyramid concept that the foundation, the inverted pyramid foundation, is based on gold and also including spot commodities. So once you remove spot commodities from the mix, once you remove the spot commodities on the eastern side of the line, being able to deliver them on the Western side. Okay, so you have shortages, you have food problems, you have all these real problems. But financially, you also create a collateral crisis, meaning, very simply, you and I, we trade futures. Let's just say we're trading futures. We're trading futures on oil. And what happens is those markets are based on real collateral. And so the less collateral in the East that is available for Western futures markets, the more stressed Western markets get. And that could result in things exploding like oil did. It could result in things like gold going higher initially. It could result in wheat going higher. So, wheat in Russia, let's use wheat as an example because it's very cut and dry. Russian wheat is winter wheat and that's not available. So real food shortages are a result of that. But in the West, wheat goes up because of the real shortages and because people start pulling their physical commodity out of the market because they actually need it now. They can't just start doing leverage. So really, when you think about it, when the East's collateral, physical commodities, went on strike, right, that forced the West to deleverage, right? And the deleveraging, a classic example of that is oil skyrocketed, but at the same time, open interest decreased. And that's because people were saying, the heck with this. I don't want to be in this market at all. Cover everything. So people were buying to cover shorts. People were buying to speculate as well. But people were also saying, well, my oil is no longer available for delivery. And that happened as well in gold. And it is starting to be felt in gold. Don't pay attention to the price right now. We'll talk about that in a second. But short story long, the sanctions, the war, and the East pulling their commodities off the market forced the West to deleverage. Now, bringing it back to the Fed's like, screw it. We can't increase supply. They call it a supply chain problem. So we're just going to really, really step on demand. And so what do? Mortgage rates go from 2.5% to 6% in a couple months. Oil goes up and it stays up, which strangles certain industries. And then you have the actual stock market starting in February, starting to crater, and it has been since then, stabilizing at lower prices, but having a shitty day today, for lack of a better word. And all during this time, except for isolated days, oil remains stable. Now, this part, everything I just told you before was pretty much fact, pretty much truth. This part is a little bit of conjecture. I feel that the Fed will keep pressing on all markets, meaning stocks. We're not going to bail out stocks by lowering interest rates. We're going to keep doing this or keep doing that. Bonds. We actually want, this is crazy, but they basically have said this, they actually wanted long-term yields to go higher because that would make it harder to buy a mortgage, harder to get a home. And harder to get a home, it slows down the inflation on the housing side. That's another demand thing. It'll slow down inflation on us buying extra GI Joes for Christmas for our kids or grandkids, and that was their plan all along. And frankly, hate them or really hate them, they executed it. Today, oil may have cracked, and I say that word. I use the word crack because it's about crack spreads, and crack spreads came in today. So today, and I don't want to blow smoke, up people's, but getting oil to crack, when oil finally really cracks, and I think today was the beginning of that, you'll see pressure come off from the Fed, because then inflation will downtick because fuel and energy costs are going to drop. But I hope that helps. Is that what you wanted to hear? Is that what?
Yeah, no, that helps. That helps. So then, is it more important whenever the Fed is going to stop hiking? Is it more important for them to see commodities continue to decline really aggressively? Or is it just a function of, maybe it's a combination, or is it a function of we're just going to hike until something really breaks badly?
Yeah, it's probably both, and that sounds very non-committal. But I mean, the path is if you look at the goal is we want to get inflation down. Step one. Step two, we have no control over supply, so we're going to crush demand as much as we can. So step three is how are we going to do that? Well, we're going to do that by raising rates, by starting QT, which they really haven't started yet, but that's neither here nor there. I mean, it's important though. And so they're going to keep raising rates until whichever happens first, inflation cracks, which will be led by oil, or something in the market breaks. So the answer is it's both. We're going to keep raising rates. We're going to keep not accommodating speculation or even regular investment until either inflation gets back to where it has to be or something breaks, like a bank or a Bear Stearns type of situation. So that's what's going to happen. They're going to keep doing it.
So, I mean, how much longer, realistically, can the Fed do that? I mean, so we know 75 is coming in a couple weeks, and then the September meeting. I mean, it would seem gun to my head. I don't see how. I mean, I guess I was too aggressive. I was saying, July is going to be the last one, but let's say that they can make it to September. I mean, November is, what is that? 4 months. 4 months away, and we look at how things are going. I just don't see how. I really don't see how they're going to be able to get to that point. I mean, rates are what, 1.5%, and we're probably already in a recession, and inflation expectations and the bond market, all these inflation indicators are now collapsing.
Right.
I just don't see how they can make it another. Like, we're at 1.5%. How do these people think they can get to 3% or 3.5%?
Right, like, right. I totally hear what you're saying there. Okay, that kind of dovetails into what I was thinking. I'm like, how do they keep doing this? How do they keep doing it and getting away with it, or without breaking something? I don't like to paraphrase what you're saying. I don't see how they keep doing this without breaking something. For 4 months doing this, I don't see that happening. I agree with you. I mean, so now I have to ask myself. It's like, well, if I don't see it happening, but it could happen, why do they think they can keep doing it, right? And I think the reason they can keep doing it, but I'll give you a timeline too, because I think it's important to have a timeline. The reason they think they can keep doing it is because if they have, they use the word tools a lot. Well, they have a couple tools, not just raising interest rates. The other one is they can facilitate long-term yields up and down without actually affecting them. And they do that with working in partnership with the Department of Treasury. So, and the other tool they have is and this is a fact. I mean, they basically admitted it. They can sell volatility, and they literally, since 2008, 2009 great financial crisis, have been active in the volatility market to cushion the fall. So when the market drops, people screen for puts in stocks I'm referring to. And so the Fed will accommodate them by giving them puts. Now, they don't talk about it, but it's in one of their statements. We're trying to offload our short volatility position, which means they sell volatility to the market. They put a pillow under the fall of stocks by keeping volatility low. And those of your listeners who look at things like the VIX is a broken indicator. Sure, it has its pops once in a while, but it never sustains like it used to since the GFC. And I've been watching this since 2010 in amazement for 2 years. The point is,
just to interrupt for a second.
No,
yeah, the VIX did not spike. It stayed really low in the last couple months.
Yeah, exactly. And that's another whole conversation. But the conversation goes like this. The Fed finds an indicator that the market trusts and relies on. And, starting in 2005, 2006, it was the VIX. And the VIX was basically a proxy for the market. When the market dropped, the VIX rally. Even if the market rallied hard, the VIX didn't really rally much because people use options for insurance. They buy puts because they're worried about their stocks going to zero. They only buy calls for speculation, and that speculation wasn't big until recently. So the Fed says they come in and they have systematically over the last 10 years been selling volatility at certain, not every day, not all day, but at certain points when the market needs it, like titrating medicine. Oh, we need a little bit more of this, a little bit more of that. And what's happened is effectively, to your point, over the last couple of years, the VIX is broken. They've trained it. And by the way, I'm talking about the VIX. This is gold too. They've trained markets that act as canaries in coal mines, like the VIX and like gold, to be broken. So people say, fuck it, the Fed's not going to let it go. They don't literally say that, but they say the Fed's not going to let it go, so I'm not going to put money in gold. I'm not going to put money in VIX or something like that. And you end up getting the baby elephant that's, tied with a rope, as the analogy goes, and it grows up, and gold should be trading 3,000. The VIX should be trading 45, but it's not, because it's being managed, which is a gentleman's way of saying manipulated. So the indicator that you and I like the VIX, for example, is broken. And that's why it hasn't spiked. It hasn't spiked because they've been sitting on it for so long that people have lost their faith in it. And every so often it'll spike like gold, and then it'll get sat on again. So the indicators that they aren't sitting on yet are things like MOVE, which is the bond volatility index. The bond volatility index has been exploding, and you used to be able to look at the bond volatility index and say, well, because bonds generally lead stocks, right? So the bond volatility index gets volatile, and then stocks will follow if the market's going to keep going this way. Well, the bond volatility index was getting very high, and stocks would then crap out, and then the VIX, the stock VIX, would do nothing. And so you're saying correlations are broken. 1 and 1 no longer equals 2, and so you look for another correlation, and that's what's happened. So they're sitting on volatility, directly or indirectly. They have definitely put a dent in people's faith in that as an indicator. So it's something to watch on TV, but it doesn't help us at all. And sadly, they have, although they haven't done it for you and me and diehard precious metals, hard money types, they have done it to the general population with regards to gold.
Yeah. So, let's zero in on gold. I know you don't. I know technicals. You prefer to listen to other people. But my one worry as a gold guy is looking at the technicals. They definitely look ugly, and even if the Fed, even if September, or even if July is the last hike and they puss out right before September, right, there's still some time where gold can get, it probably needs to rally a little bit because it's really oversold, but the chart is really ugly, and it suggests that you could get a flush like in '08. Is that? I'm growing sympathetic to that view. Do you feel similar?
Yeah,
do you feel different? What's your view?
Well, not as a chartist, but the circumstances are showing up that the word flush is a good word, that sort of thing could happen. And so I'll paint a picture that's real and possible. Anytime the Fed raises rates, stocks drop. Historically, stocks drop and gold drops. Now, I'm not talking about QE, QT. But when they raise rates, the stocks drop and gold drops, or when they say they're not going to lower rates. And in the past, I'd say anytime before COVID, stocks would drop 1% and gold would drop 2%, right? And we see how that works. Like gold is easier to sell than stocks because people hold their stocks longer. Whatever the reason, gold gets punished too much when they're trying to keep a lid on stocks. And that's because there's been decades, not days or months or years, but decades of abuse of precious metals as an asset. And you can see that going on now. So what what you're looking at as a result of that is so when you take that behavior, right, and that behavior was the past before COVID, it stopped after COVID, right? So stocks will go up, gold will go up. Stocks will go up 2%. It used to be stocks go up 2%, gold goes up 0.5%. Then it was like stocks go up 2%, gold goes up 1%. Then it was stocks go down 2%. And then recently when the war started, it's like stocks down 2%, gold unchanged. You're like, oh, okay, that's pretty cool. We have a real market, a real U.S. flight to safety out of stocks. I'm okay, that's cool. But how long did it last? And this is where I go, yeah, you could be right. And this is part of, I'm just kind of like reading your mind. When you said earlier, how long can it, paraphrasing, how long can they keep doing it? Something's going to break. 4 more months of this is crazy. Yeah, you're right. 4 more months of this is crazy. But in my mind, as you're saying, I'm like, yeah, where's gold happen if they keep doing it? Where's gold go? And as everything. So let's assume that it's the end of the world, right? In terms of the Fed continues to raise. Let's start with the worst case scenario. The Fed continues to raise until something breaks, and nothing breaks, and so they keep raising. And something has broken, but they're already behind the scenes fixing it. Believe me, they're doing that now. And as they're doing that, they're not going to fix gold. You know what I mean? They're going to let gold go. So you're going to see stocks drop 4% and gold drop 1%. And then you'll see stocks rally 1% and gold drop 1%. And so over the period of months, the next 4 months, and I'm not predicting lower, but I am saying why it makes sense. For the next 4 months, for several reasons, we have to get inflation down. People are losing money on their stocks, so they're going to start selling stocks and then selling their winners, their gold isn't a winner anymore either, and selling their losers to offset tax losses. So in the U.S. investor, you're going to see, I'm going to sell my winner in Apple that I've had for 10 years, then I'm going to sell my GLD that I've had for 6 months to offset the gains a little bit. You're going to start seeing that. You're going to see momentum funds that have already heavily shorted silver from like 22, you're going to see them start to lean into gold, and they haven't even shorted gold yet. So can we have a flush? That's a great word. Yes, and the answer to that is invariably whenever there's a flush, and nobody knows when it happens until it happens. What you'll see is, and this is a little bit of an aside, you'll see the open interest go up in a down move. And that will be the momentum funds starting to sell it. And so does that mean we're going back up? No, but it does mean that the descent will slow. So if that happens, and I'm not speaking for you and me, I'm speaking for how the general population is. If the general population gets bullish gold, I'll put it this way, if we're bullish gold, the general population is 10 times more bullish stocks. And that's what will happen. So if they break it again, you'll have a turnaround. But, the good news, and I'm not so sure it's good news, is that this won't last forever. The world is now completely bifurcated trade-wise, and that means that the gold market is going to really, really split. There are all different ways I can go with this, but to answer your question more directly, if you're looking at a technical chart, yeah, a washout can happen. There's all kinds of trend lines underneath that are begging to be touched. And although they're not looking to hit gold anymore, believe me, they're not looking to sell gold anymore. The banks are not selling gold, and I'll give you a silver indication on that as well. They're happy if it goes down because they do want to buy it, and that's what's going on. It's unfortunate, but. Put it this way, gold dropped like $70, $80 before oil cracked, right? So now they got what they want out of oil, and gold could, now to do the flush thing again, gold could drop $10 when oil drops $8, which is it's a big move in oil, right? And then one day oil can rally 10 cents and gold could drop $50. And we'll be like, why? There's your flush, right? Why is that happening? Well, it's happening because someone threw in the towel in Europe. Some fund got out, said, fuck it, I'm getting out of my position, and they sold, and the bullion banks saw it, and they got ahead of it, And they caught the falling knife, but they caused the knife to fall. I mean, I hope that's helpful somewhat.
Yes, that is. So let's close on, before we were recording, you were talking about your view about how this would play out, I think, macroeconomically.
Oh, yeah. You right. You were talking about, I forgot that part. You were talking about the timeline, right, to November. And that's a great month that you picked. And here's why. I have a feeling about the following. And it's my feeling, but I've read in other research reports that I like. Hold on. Okay, I was just looking. So the chat was opened. I don't know why I thought you were chatting me. The research reports that I read that did not take a stance. I mean, all the research reports that you're reading out there that are good, not bad ones, that are good, are saying the Fed's going to raise rates until something breaks. Fine. And you and I are going, okay, well, what if nothing breaks? How long will they keep raising it, right? And I'm saying, and other people are saying, the Fed will keep raising rates until inflation under control. And I say oil. And the third one that I'm reading, I'm just starting to read now, but they don't talk about it too much, at least not in the U.S. banks. And I think this helps with our timeline. I have come to accept that A, the Fed can keep doing this until November. B, they can selectively target who they want to bail out. And I don't mean literally bail, but they can say, okay, the stock market dropped 1,000 points today. Let's back off a little bit, and you'll see it go sideways. We dropped aggressively from February through May, and then we kind of went sideways from May through July. And then oil cracked, right? And now oil's down, and actually gold cracked first. Everything cracked. If you look, copper, metals broke first. And I'll give you a reason for that. China's in trouble. I mean, it's not the end of the world for China, but China's in trouble because their GDP is like 350% of their money supply. And our GDP, to give you a comparison, is 100% of money supply, give or take. So China needs more stimulus to get out of whatever recession they have. It's become a big political problem. You're seeing bank runs. I don't know how much of that is fabricated or how much of it is real, but you're seeing bank runs, and the Chinese are not like the Americans. They're a little bit more apt to speak up if they're not happy in a more violent way. So China's lack of demand for copper crushed copper, right? Copper is no longer, in my opinion, a doctor tracking U.S. stocks. It's all about Chinese flows and do they have money? Well, they're running out of money, and I say that in a very loose term. So the Chinese companies and banks and government are saying, well, we need to start selling our physical. So the U.S. government is, as a bonus, wringing out the liquidity in China as well. And that's something I think that the federal government wants to happen, and that's what's happening. So copper gets hit. So you have the stocks down from February. That's the initial thing is the stocks get hit in February. Boom. And then we start to see the metals crack. You see copper get hit. You see silver start to take water on, and gold just kind of hanging out there because of the war. And then other things break. The wheat goes from limit up to limit down. Lumber's already been taking its hits. And so, but oil's not budging. So they're pressing the button again. And so oil finally cracks. Will that be a bottom for gold? No, I'm not going to say it's going to be a bottom, but I will say that that's how things are going. And if the Fed can now continue that, or is it lather, rinse, repeat, and now continue to do that and rescue stocks by selling some puts to the market, or by the way, QT should have started by now, but it hasn't. They've actually delayed QT. So, maybe they're already doing stuff to make sure that we don't crack at the same time that China is cracking. So to answer the timeline thing, here's the thing that only one other firm is talking about, and it's not an American bank. And I'm like, oh, yeah, this is really good. Since the transitory era, this is a little bit of a narrative, but it's something I'll trade on. Since the transitory era, the Fed got called out by the Biden administration. The Biden administration called them out because political press was like, okay, we have inflation in the headlines now. What are you going to do about it, President Biden? And President Biden has a meeting with Powell, and he says, okay, to Powell, I'm making this part up. He goes, okay, I'm going to re-up I'm going to renew your job, whatever you want to call it, reappointment. But I want you to make sure that you're committed to getting inflation down. And Powell, who may agree or may not agree, is compelled to agree. And that's because I believe the position is extremely political. So Powell comes out and says, he'd already said, like, transitory, I screwed up, right? He admits that. And then he starts talking about what he's going to do. And then he starts doing it. And then it starts happening. And inflation's still in the headlines. And Biden's still going, we're fighting inflation. He's blaming this. He's assigning blame. He hasn't assigned blame to Powell yet, but he's going to if it doesn't get down. And so Powell is fighting inflation. And here's where it ends. If you and I, we're looking for something to explode. Maybe something won't explode. You and I, we're fearful of a collapse in markets and gold, as collateral damage because of him continuing to raise rates. Here's where it ends if it doesn't end because of a crack up or inflation being lower. It ends when the press starts saying recession is a bigger concern than inflation, which is not the same thing as inflation being gone. And here's where the political aspect of it comes in. And this is what I read in the report. The report said, very simply, it said, Biden is the good cop for killing inflation. Powell listens to Biden. As soon as we get either a crack up, which you and I are looking for, either something imploding, or inflation at 2%, which is not happening. It's not going to 3.5% in rates and getting inflation. It's just not happening. Or the third thing, the political aspect. Biden, who, it's increasingly becoming apparent that he might not run. I'm not political, but I look at policy and behavior as it affects markets. Biden, it's increasingly look like he's not going to be running for president again. So if you're a Democratic operative, you're like, I need to get everything I can out of him if he's on his way out. So he's fighting inflation. It's kind of like Gerald Ford, whip inflation now. And Powell's like, okay, I'll do what the president says. And as we near the midterm elections, they need to get inflation out of the headlines. So I think Powell is biased towards tightening until November, or maybe it's earlier, September, but maybe it's September, October, but November's the cutoff, because if you believe they're going to raise rates in some way, shape, or form between now and November, I believe they do it to September, but that's just an idea. I believe September they back off, because at that point, recession starts to become a competing narrative with inflation in the headlines. Biden's polls go down because of inflation for 6 months. Now they're going to start going down because of recession. And then after November, then we get a change in bias by the Fed, where the recession is now the bad cop. So Powell says, screw it, I'm going to stop raising rates and I'm going to lower rates. I cut you off. I'm sorry.
No, I'm just because, and that's exactly what we talked about for part of the last interview we did. I mean, when does, so, and I think your answer is great, because it's the psychology, the Fed, we know the Fed's political. It's right. The psychology of, it's not market indicators. It's going to be the psychology in politics, how everybody feels out there. And I think the November time, like, that's a stroke of genius by you, the way you're looking at it. And who knows, that'll probably align with, a couple, you get a couple more months of 3 or 4 more months, but the way everything's trending, by that time, it's going to be clear and obvious that recession's a bigger issue. Now, I know you have to run, but just quickly, one more thing. We didn't talk about the dollar, and I know Zoltan's the Fed whisperer, but you're a Fed whisperer yourself. But if the dollar, I didn't see it today, 107, 108. If that thing gets up to 112, 115 in the next couple of months, you'd have to think that also acts as tightening. So is that what?
That's extremely important. That's extremely important, Jordan. That's extremely important because without getting into the whole, I think the dollar's strong because half the world's not using it, and the other half is underwater.
The glue factory, we don't need to hear that. Yeah.
Right. Okay. So we'll just stay on this direct point. The dollar strengthening is. We talk about the Fed's behavior as being potentially destroying something, a bank, a mutual fund, a hedge fund, what have you, a company, right?
A country.
Dollar strength, yeah, well, now you're getting to it, right? Yeah. Now, the Fed, the dollar, specifically the DX contract, which is over 40% euro in combination, is reflecting dollar strength is your first sign that something can really break. And I'm not talking about U.S. stocks. I'm talking about, to your point, country, specifically the euro, which is a conglomeration of countries. And if you remember back in COVID and even before that, during Brexit, the dollar got so strong from people in Europe worried about, the word they're using now is fragmentation, Brexit, Frexit, Ital exit, all these exits were being talked about, Grexit and all that shit. Well, what happened was, if you're in Europe, you're like, shit, there may not be a euro. So if you're a European, you're like, I'll put my money in German bonds, right? Because I know Germany's bond market will be there. I'll put my money in US dollars and I'll put some money in gold. But, the euro was cratering because the dollar was so strong because of all the demand and there was not enough dollars out there. So during Brexit, the U.S. opened a special window, they call it, which basically made their banks have access to our Fed window. That will have to happen again here. And if I have to put money on something, I put money on what you just implied, that the thing that breaks first is stuff that's out of the Fed's direct control, but the Fed is responsible for. So I'll paint a very quick picture for you. The strength of the dollar really starts to hurt Europe. How does it hurt Europe? It hurts Europe because the dollar is stronger, the euro is weaker, Italian bonds get pulled out of, and they start putting their money in German bonds. And so the periphery countries, the European South, which is less an economic engine, starts fragmenting again, which shows that the whole economic status of Europe isn't really that good, which shows that the euro is probably a piece of worthless paper because they don't tax uniformly. And then Europe says they created a special tool, like we're going to create the special tool, like forget this. The special tool is we're going to raise rates for Germany and lower rates for Italy. It's ridiculous. They're basically saying in Europe, we are putting our feet on the brakes right now, but we're going to put them on the gas at the same time for Italy. It's ridiculous. It's like, a person with caffeine, a person with a caffeine buzz taking, sleeping pills to calm down. It just makes you messed up. And that's what they're going to do. So if the dollar remains strong, and it will remain strong until something breaks, right? And if that thing that is most likely to break, or cry uncle, we'll call it, is a European thing, then the Fed opens this window, this magical window, makes dollars available to Europeans, and the dollar weakens and Europe stabilizes, and that probably is bullish for our stocks. But yeah, that is my leading my leading candidate for what will break is Europe. And it's kind of like, if you look at the history of Brexit, and if you look at the history before that of Grexit, it's Europe that really can't keep their shit together, that we keep bailing. I mean, we cause it too, that, right? But we can't keep bailing them out. So that's the dollar strength is hurting everyone, but it's hurting Europe the most because there aren't enough dollars. I mean, they should just go off the dollar. You know what I mean? Like, that's what they're on. They're on the dollar, basically. But yeah, it's a dollar. You're right.
Okay, Vince, thanks so much. I know you have to run right now, so I'll post a link to Gold Fix, which you publish for all the listeners out there. Thanks so much, and hopefully we could do this again the next couple weeks.
Oh, yeah. Well, we'll hopefully have some good news to talk about since then. But, they're still buying gold. There's physical buying. I just want to add this one thing. the gold spot market is over the U.S. gold futures market. That is a sign that physical players are buying gold. It's not bullish today, but it is a sign that the people selling gold are the wrong people, and the people buying gold are the right people. So $50 lower is a discount. $50 higher is shorts covering. That's my feeling on it.
All right. Thanks so much, Vince. Talk to you next time.
Very cool. Thanks for having me, Jordan.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.